A few weeks ago, I was on a live stream and someone asked me whether or not market makers were real and how they impacted the market. And it's a pretty interesting question because I think it's something that isn't really talked about, but actually has such a massive implication on how the market moves and also how you can go on and sort of trade or position yourselves to take advantage of that. So in this video, I give my explanation of what a market maker is, how they utilize the markets, and then how we can sort of understand where in the market they currently are, where they sit, and that means we can lead into how we want to trade or position ourselves. If you like the video, then please do drop a like, subscribe to the channel. It's greatly appreciated. If you have any questions, feel free to drop comments in below and I'll try and answer as best I can, and enjoy the video. Cheers now. Next thing I wanted to talk about this evening was market makers, and Dig Coop, hope that is your, I know it's your Discord name, but hopefully I didn't butcher that when it came through. You asked about market makers, and if you don't mind, I'm just going to kind of show the conversation we had. You sort of went on to say, I can't shake the idea that there's a lot of crypto trading is now automated by bigger boys. And when I see stuff like this, any idea how to disprove the notion? And I sort of went on to say that much of it is, I don't think there's anything to disprove. You asked if you could spend a bit of time talking about, which I'm more than happy to do. And for those of you that have watched a lot of my calls, had a look through a lot of the charts that I like to post, you'll see that I utilize a chart setup like this, an indicator like this, and it has some pretty funny colored charts on, some crazy identified EMAs, which you might wonder what on earth I'm using there. But this is all based on market maker theory. And I got introduced to market maker theory 2022 probably, as a YouTube channel called Traders Reality, guy led by a guy called Tino, absolutely fantastic. Speaks incredibly fast, but his understanding, in my opinion, of the market makers is unrivaled. There's some other ones, Trade Travel Chill, who is also very good at it. But I speak about Traders Reality because they do a free indicator, which you can get on TradingView. And I think there's even a free 1-hour course, which really helps to break this down. And I would recommend, if you are interested in market maker theory, even if it's not to trade, it's just to have an understanding of who they are and what they do, definitely subscribe to both of those channels. Have a look at some of the videos, but one of the videos that I really recommend is a Traders Reality video, and it's before you trade Bitcoin, you need to know the market maker. It's only 20 minutes long, and it just sort of goes through who the market maker is, not per company, but just generally who they are, what their motivations are, what they're doing in our market, and how they can exploit price action to really take the most and the biggest bites out of retail. And that's ultimately what they're here to do. So that's kind of where I base my own. Apologies if I butcher it, but definitely check out that video. It'll give you a pretty grounded understanding. But let's give my understanding of where market makers are, and we'll go from there. And I know a lot of people don't like Investopedia. For me, love it or hate it, they do give some pretty user-friendly definitions. So they've got a market maker definition, which is mainly about traditional financial markets, but it is exactly the same with the crypto market. So we'll have a very quick run through of this. We'll then have a look at, from a crypto point of view, we'll have a look at some of the market makers that are around in this day and age, and then we'll have a look at some of the charts. I'll explain the, sorry, I'm just, here we go. I was just looking for some notes that had happened to close on me. But their definition here, the market maker is a firm or an individual, I'm not sure there's many individuals that do it, but maybe I'm wrong there, who actively quotes two-sided markets in a particular security. Well, we don't want to fall foul of the SEC, so assets, cryptocurrencies, whatever, providing bids and offers or bids and asks along with the market size for each. So what we're talking about here, we're talking about someone who is providing liquidity to the market, okay, to the market size there, in an asset class that people can buy and sell, and, which we'll go into a little bit later on, they will also, well, predominantly pick up the other half of the trade. So, you know, standard thing is in the market you look at, particularly cryptocurrencies, derivatives tradings, if you're wanting to go long, you actually need someone else to go short. And whilst you may be doing this on an exchange like Bybit, Mexi, Kraken, whatever, they may not have the liquidity to actually take on the opposite of every single trade that is produced on their exchange, because thousands of them at any given time. And so they may farm that out to market makers, and that's generally the service they provide. Now, I may, when I'm talking about this, I'm probably going to be referring to sort of liquidity within the market, and also taking in the opposite side for any derivative trading that you may be undertaking. But there are other roles in which market makers have, and I just want to go through those as quickly as I can, and then we'll focus on providing the liquidity afterwards. So I've just gone on KeyRock. So KeyRock are a market maker. They're not the only crypto market maker out there, but during the research of doing this is just a pretty good article which explains some of the roles that they undertake. So they can talk about market maker. They give it as an example, but it's effectively the definition that I've already provided. They try and streamline that down from sort of like a cryptocurrency point of view, and they're basically, it's the same definition, but they've got to be a bit more innovative in some of the services that they offer. And that's why there is a multitude of services that they do offer. The main one being providing liquidity, which we're going to talk about in some detail in a moment. There's also mitigating arbitrage, and there are if markets were illiquid, there would be arbitrage opportunities, which I'm going to end up talking about when we talk about liquidity. So we'll just put that to one side, but that's another service or role that they provide. Market making for token adoption. So when we talk about liquidity, we're talking about, you know, some of the big boys, but if you were a new project that was coming in, you may have devs, core teams, pre-round sales of people that have actually got on board your project before the public have, and you may even have dedicated a certain percentage of your allocation to the public when your token lists. But ultimately, actually, what happens is the guys that already have it have been involved in the project from the beginning, and also those that are in the pre-sale may have vesting periods, a lockup period, so that their tokens aren't liquid to be sold at the moment. And so you're relying on what is allocated to the public at time of launch. But who actually owns those? Who actually takes those on board? Yes, you may be able to give someone to the exchange as a fee, but also what you may look to do is utilize a market maker who will take those tokens off you, and then they don't care about the buyer, the seller. They're not necessarily here to make the money from it. They're just to then spread that across exchanges so that bidders and sellers can actually buy or sell those tokens, providing that initial liquidity from launch. So that's another service that is provided. Working with exchanges, so it's not just one exchange, it's spreading it across other exchanges. And additional solutions, so this is just one example, but over-the-counter trades for larger investors, etc., that want to buy without influencing the order books. So that's it is. Now, I mentioned KeyRock. There are other ones that are out there. I just Googled this in sort of like top crypto market making companies of 2024. This is as of April this year. We've got CLS, DFW Labs, Flowdesk, GSR, Acron, Caron Labs, Reform, Wintermute, Jump Trading. So there's plenty of companies that go out there and do this. But I think from a retail point of view, most of us just stick our head in the sand or don't actually understand that the exchanges we're dealing with don't generally have the liquidity to undertake this. Yes, Binance is the big one, and we know from having a look at sort of what their holdings are, they have quite a lot of liquidity, but do they have enough to hold every single trade that's going on there? Unlikely. They're relying on other third parties to undertake that. So that's why I say it's almost like an open secret. It's perfectly out there, just no one seems to ever want to talk about it. But these people do exist. And they're not doing it out of the goodness of their own heart. They're there to try and make some money from it. But let's talk about their biggest role, providing liquidity. The reason I mention that is because if you think about it, well, let's just use Bitcoin as the example at the moment. But if you think about the sentiment, the narrative, the reason we hold Bitcoin, right? A lot of people buy, institutions and retail, buy Bitcoin, and they're not really looking to sell it, at least not immediately. So if we didn't have market makers providing liquidity to the market, what you'd actually find with Bitcoin is a very illiquid market, especially during bull markets, because most people understand the 4-year cycle, understand the requirement, the uptake, the narrative behind Bitcoin. They want to buy it, and they're not necessarily looking to sell it immediately. And when I say immediately, I say within 30 days. And that actually creates quite a dry order book, an illiquid market. Now, without market makers providing that liquidity, what you would then have is if someone did come along to try and buy Bitcoin, they would need a genuine retail institutional seller to also want to sell, because if you want to buy something, someone has to sell you it, okay? And what that would mean is, because there is an illiquid market, a dry order book, the price of Bitcoin would actually massively fluctuate. And let's, give I would say a made up example, but I'm sure there's plenty of people that do this. But let's say you wanted to buy 100 Bitcoin at 60,000, or the price of Bitcoin at the moment was 60,000. You went on to Binance, but there were no market makers. You'd actually have to genuinely look at the order book for people that have been listing to sell their Bitcoin. Now, it's a good chance that not many people who've bought Bitcoin in and around 60,000 are immediately going to want to sell it. So you're going to have to try and entice them to sell it. So they may be putting large figures, 70,000, 75,000 on there. And as you work your way through an order book to try and fill your full 100 of those, the price may touch 80,000 before you've finally bought that last Bitcoin, just because the order book was so dry. What's that going to do to the price of Bitcoin? Well, if no one else buys Bitcoin immediately afterwards, the price of Bitcoin is going to sit at 80,000. And that, volatility because the price massively could spike up in Bitcoin, is generally off-putting to retail, because no one wants to start buying at 60,000 and end up buying at 80,000. But also, it's off-putting because, sorry, I lost my train of thought there. It's off-putting because that volatility can lead to arbitrage situations, which we talked about market makers there. Whereas if I've gone and done all of that on Binance and the price now is at 80,000, what's that do? If every other exchange is looking and selling at 60,000, there is an arbitrage opportunity for anyone who can sell it. And so these market makers are here to provide that liquidity to stabilize the price. It can still go up and down, of course it can, but what they want to do is just flood the current price and in and around that current price with as much liquidity as possible. The people who are buying Bitcoin, and let's face it, average Joe isn't buying 100 Bitcoin, but if they are buying one Bitcoin, they get it for the price that they set it at. They don't have to move the price of Bitcoin by $5,000 just to buy one Bitcoin. And so that's their main role within the spot market. Now they have another role, which is what we're going to focus talking about in a moment, from that derivatives kind of market, perp trading, all of that kind of stuff, in which when you go to trade, when you go to go long, or short, it's a two-sided trade. If you want to put a long on Bitcoin at 60,000, someone needs to put a short at Bitcoin at 60,000. Now for us, when we place that on Bybit, Mexi, KuCoin, whatever, we never really even need to think about it. It's instantly filled. And that's instantly filled, not because there is a retail person. There may well be a retail person that's wanting to take the exact opposite of your trade immediately as you place it. But it's highly likely that the exchange actually is either taking on the other half of that themselves, or what's more likely, because they don't want to end up losing money, is they farm that out, as I mentioned earlier, to liquidity providers, to market makers, who will take the opposite side of that. Now, what's the issue there, or how's the house gonna win? Well, when we go and do derivatives trading, we're using leverage. Okay, so we have a liquidation point. Market maker doesn't. Market maker's providing liquidity. Why is he going to need to have leverage? That means he can hold his other side of that trade open for as long as he needs to. He's not getting liquidated. He's not going to liquidate himself. And so he's not playing with a square bat. I was going to say a fair bat, but it is, that's the role they play. So it is fair. We accept that when we go into it. But that means that they can hold runaway trades for an inordinate amount of time. But it's not within their best interest to do that. So what market makers prefer to do is they like to move the price in a certain direction. And this is where we're going to go onto the charts now and just have an example. Today is Tuesday, the 20th of August, 2024. And the price action that has happened today is a perfect example of what market makers like to do and how they can manipulate and move the market, driving a frenzy within retail, and they're the ones that benefit from that. So let's jump into the charts and let's have a look. So I'm Bitcoin chart here, and I'm down on the 15-minute time frame. Now, for those of you who know, when I used to trade derivative trading, which I don't really anymore, I didn't like being on the nosebleed time frames. I liked being on the 12 of daily. But actually, that really didn't work for myself in the long run, because look at this. We are talking about sophisticated organizations in a market that is open 24/7. Yeah, they may work just Monday to Friday. But in that Monday to Friday, we've got Asia, the UK, and the US. And I'm not here to explain how to trade the market traders. But what I'm saying is there is 3 markets that are generally open for that entire 24-hour period. Okay, so they are going to be able to take advantage where we're just men and women that need to eat, need to sleep, need to go to the toilet, need to have a social life. So we're not in front of this the entire time, but there are trained professionals working in offices that do their stint in Asia, hand over to their comrades or colleagues in the UK. They get to go to bed whilst the market maker's still live, still open, still ready to go. So we are not playing the same game that they are playing, and they are trying to take advantage of that. So trading on the daily and on the 12-hour can actually, I mean, unless you've got, some decent stops and some really good TA backing it up, markets can reverse very quickly, much like what we've seen today. Okay, so before we have a look at today's price action, let's just go over what we can see on the charts, just for those of you that haven't ever seen it before. So I've got at the moment the PVSRA, which is these colourful candles talking about market sessions along the top, Asia, UK, and the US. I've got my own EMAs, and then I've got that Traders Reality indicator. I have turned off a lot of things from the Traders Reality indicator, but we'll just go from there. So we've got these vector candles. Okay, these candles are the red, the green, the blue, and the purple magenta coloured candles. And what they are signifying is periods, so candles of extreme or increased volume at that given time. So if it's green or red, it's over 200% the average for the volume. If it is blue or it's purple, then it's 150%. Why are they important? Well, they show where there's a lot of excitement one way, one direction or the other, that has indicated that there's a lot more transactions and trades that have been taken in those periods. And they create these vector zones, these trapped liquidity, almost retail liquidity, which market makers can then utilize as targets for where they may want to take the price towards. We've also got some EMAs on here. My EMAs are slightly different to the Trades Reality ones. I use the 10, the 20, the 50. So the light blue is the 10, the red is the 20, the dark blue is the 50, which also has the purple cloud around it. I've then got the 200 and the 800 EMA. Now on the 15-minute chart, the EMAs get broken all the time. They're not something we necessarily have to worry about. It's just ones that I use, but they are important levels nonetheless. So let's actually have a look at what's happened today, because as I mentioned, today's price action was utterly perfect from a market maker's point of view. So and this is from a derivatives point of view, just to sort of reiterate that. So what have we got? Well, this big green candle here actually happened pretty much at the daily open. So, 1 a.m. in the morning, we're talking about the Asia time frame here. What's going to happen? Market makers have started to move the price up. But in doing that, they have induced the appetite of the retail market. We've seen an increased amount of volume as price has gone up. What does that mean? That means that people are getting worried about FOMO. So they start placing their entries at these levels. Okay, they're longs, right? They're using 10, 15, 25, 50, some of the degens themselves, 100x leverage. But what's happening there? Of course, the market makes it taking the opposite side of that trade, okay? So they can utilize the excitement of retail and the trades there to just take the opposite side of the trade. So when those trade positions, or if those trade positions, the price retraces, they get liquidated. Obviously, the opposite side of that was a long, it's going to be a sell, gets sold, taken up back into the market maker's hands. So we can see this sharp move up, okay? Still through here. And what's probably going to happen by the top of this, I mean, it's only 15, 30 minutes into it, is they've realized they've got quite a decent amount of trap traders within this. So they just have to slightly move it down and they can cross off 1, 2, sorry, I'm using the trackpad here because I've not got my mouse plugged in, so you can't see them. But those 3 little loans that I draw, which are just symbolic, of course they are. And already those ones there being closed out. Let's just get rid of those so we can see a bit clear. But then what do? They give a bit of stabilization, a bit of period for everyone to just catch their breath for a couple of hours, and then they mark the price up again. Price starts to go up again. How do we know they're marking the price up? Because the vector candles are showing us that retail's getting excited. They're moving with it off the back of this, and then we go. And then they get to a point actually, right up here, and in this instance, sort of 64,000. And they think, well, you know what? The last couple of hours, we've actually moved this price up 2,000, okay? Now, if we leave it going up and up and up, what retail may do is not be greedy. They may actually start to close those positions. Market makers not making any money from that. So they realize that at some stage we need to reverse it. And so that's what's gone and happened. They look to then reverse the price. And as price is coming down, yeah, all of these previous, long positions with high leverage, very close liquidation price to current price action are getting closed right into the pocket of the market makers. And then what do we have? We have another little move up just to see if we can gauge any more excitement. And then bang, they mark it down. And they absolutely close out all the positions, taking the price beyond where it was 24 hours ago. So in a 24-hour period, we've moved the price up $2,000. We've given everyone a bit of time, a couple of times to get in. We've been stopped out. We'll go again because it's still looking quite bullish. Get caught out again. We've hit the 50 EMA. We're going to bounce from this one, move it back up again, and then a sudden reversal. And before you know it, price has actually gone down to where below the daily open. Market makers had a field day there. But it's not the only thing the market makers doing though. And this is the psychology side of things. This is where you need to be thinking it through, because market maker has a plan. So as he's driving price up, okay, as price is moving upwards at a rate of knots, what is he doing? Yeah, price is going up, he's selling. All right, as price is going up like this, the market maker is selling a position. Because what you do with an asset that you've bought, when the price goes up, you sell it, don't you? You don't want to buy high and sell low. No, you buy low, you sell high. So they are also selling into this movement, okay? Which seems, I don't know, counterintuitive for us traders. Why would we want to sell? But that's what they do. And then they just wait. They wait. So they've sold all that. They've made all that money on the way up from selling their asset. Then when they're driving the price down, everyone's getting a bit more fearful. What are they doing again? They're buying. They're buying at these levels now, buying back their Bitcoin, getting more bang for their buck, whatever it can be, all the way down. And then lo and behold, give it a few bit longer on a 15-minute, we'll probably start to see some reversal. Why will we start to see some reversal? Oops. Because we've got, let me go to that, we've got these vector zones forming, haven't we now? We've had 5 or 6 candles on the down, and we started to create this red shaded area, which is showing us that we've got trapped liquidity in there, okay? So people have gone short. People have gone short in that position, okay? Buyers already taken the longs from those and also bought his Bitcoin. Then that's an ideal target now for him to move back up. The other thing that's an ideal target for him to move back up towards, the EMAs, especially the 50 EMA. Yeah, so driving that price back up there, and then maybe they take another step down and move it down. And I don't want to go into sort of the strategy of it, but generally these like to move in threes, okay? So one move down, a little bit of a consolidation, another move down, a little bit of a consolidation, final move down, then we look at the reversal. But the one thing, and just sort of try and prove to you, we'll do it on the 1 hour, or maybe even the 4 hour, just because it's just easier to see. But why vector candles so important? Because vector candles 9 times out of 10 always get recovered, okay? So let's have a look at this sharp move back down. What have we had? Massive move back down. We still do have some exposed vector candles, okay? But look at these ones. Large move down, green candles trying to pick it back up, but ultimately we had this big red move down. We know that is a vector candle. And what's happened? We've hit the bottom and we've started to pick up some of this red. That would have been red shadowing there. The green candle started to pick it up. It's obviously left its own green mark there. We go a bit further up, price action is just eating into this vector candle, come it down. Close that, take that final bit with this one. Head back up, what have we got? Green vector candle forming. So it takes out the rest of the top of that one there. It's forming its own pattern, come up. Head towards the right hand side, red candle, nothing there to take out, but this red candle here starts to take out this green zone that was left. Red candle down, green candle back up. Green candle's up, red candle down. You get the picture. You could scroll back any amount in time and you'll find that's there. Now, there are some, as I mentioned, that's still there. I mean, there's one dating all the way back to June, 70,000, still there as a target. But in this period here, green up, red's down, green up, red down, green up, red down, green up, red down. Just give it time, vector candles recover themselves. So with that in the back of our mind, knowing 9 times out of 10, probably higher, 95 out of 100, we can see some vector candles. Now, earlier on today, this was a green vector candle on the 4 hour. It's now a red vector candle. We've already covered it, okay? And now we've formed our own one. So at some stage, this may now be targeted. And, given what we've done in the last few ranges, all these previous red and green vector candles have all been closed, have all been in that tight range in and around the 50 EMA. So it may not even take a couple of days before this one has recovered. But we do have a bank of red vector candles up here, and we've got this green one down here. But as I mentioned earlier, from a derivatives trading point of view, market makers not too worried. They've got a liquidation point. They're not paying fees for having these trades open or anything like that. They can hold them open indefinitely. And if we go on to the weekly, I'm sure we've got some down at 30,000. Okay. Now they may have come up to other remits to close those down. I don't know. We can't see. This indicator doesn't actually close itself down as and when liquidation points are hit. We can just use this as a visual representation. So maybe they have closed those ones, but we can still see there are some vector counts even on the weekly that are formed up here. And I would expect at some stage, in this range that we've been in for the last 3 months, to see price action head back up there. I mean, we're going to need to head back up there, close that vector zone, even if we want to see the new all-time high. So they're interesting things to use. And maybe that was a little bit of a longer explanation than I necessarily needed. And ironically, probably not detailed enough if you really want to listen in on it. But hopefully, Decoup, it just sort of gives you that indicator that there are people out here doing that. Yes, they're providing us a service, but they ain't doing it free of charge. And a matter of fact, they'd probably happily pay a little bit to the exchanges for this service, because the amount of money that they can make off the back of retail and just that level of knowledge that it provides them in the game, and the fact that they can manipulate might be the strong word, a bit of a negative, but move the market in the directions that they want to go. That's why I follow it. And I find it fascinating. And okay, sometimes they don't always play out. And trust me, this is not a 20-minute explanation, you're good to go. It's something you need to study, look at, backtest, go again. But it is there. It's definitely a thing, and it's worthwhile looking at. And it's naive to think that there aren't large institutional players that are doing this. Now, Alameda Research, they were one of the big boys that did this back in the day. And look what happened with them. Obviously, they went under with FTX. And this is not an opportunity to go through that. But the point I'm trying to make is Alameda Research had a very strong relationship with FTX. That strong relationship, it didn't even swing lightly into shades of grey. This absolutely crossed the line in terms of the level of information that was passed from FTX to Alameda Research. Some of the backdoor access that they were granted was obviously illegal, and court cases have proven that to be the case. But if Alameda Research and FTX had that relationship, there's got to be other relationships out there. Maybe not as bad, maybe not as nefarious and as illegal and as fraudulent, but there are going to be people out there that are working with the exchanges so they can maximize their position. So just tinfoil hat maybe, but just bear that in mind going forward. Yeah, so just to reiterate, definitely Trades Reality, Trade Travel Chill, two very good influence, I suppose, that talk about and deal with this. So even if you don't, they do, I think both of them have paid subscription channels, but they put out some really good free content anyway. It's well worth just watching. If you like watching YouTube videos based on cryptocurrency, I can't recommend either of them enough. Okay, so I hope that gives you a better understanding of what the market maker is, who they potentially are, and how they utilize the market. If you haven't already, again, please drop a like on the video if you enjoyed this kind of content, subscribe to the channel, and I'll see you in the next video. Cheers now.